Welcome from me, Guy Munson, to what will be our 97th 6 Minute Strategy. I'll be taking a short break in February, but we'll be back with a revised format as we head towards our 100th recording. In our client meetings so far this year, the question's been the same. Yes, we see the outside geopolitical risks in 2024, but where can we still go to generate investment returns? In the slides ahead, we'll look at 4 opportunities. First, harvesting yields that are well in excess of expected inflation from UK investment-grade bonds. Second, capturing the strong earnings growth across global markets, particularly in equity income and dividend strategies. Third, despite the extraordinary competition from China in solar panels and electric vehicles, there are still multiple ways to capture the unprecedented decarbonisation and electrification agendas. Finally, against a backdrop of extraordinary political risk, the UK surprisingly looks to be something of a safe haven. Let's look at these in more detail in the slides ahead and see what they mean for your portfolios. So let's begin with opportunity number 1, UK corporate bonds. You can see in the left-hand panel the corporate bond index, that's the dark blue line, yielding about 5.3%, up sharply over the last 2 or 3 years as interest rates have surged. Add in a little bit of bank debt, take a little bit more aggression in credit, and you can push that up to 550 or 560. Now that's remarkably attractive compared to UK inflation rate, which we think will end 2024 at somewhere around 2.5% as the energy effects fall out of the index. On the bottom level line there, you can see spreads to UK gilts, good, attractive, about the 20-year average. On the right hand though, you can see how much more attractive corporate bonds have become than underlying equities. That red line is the UK corporate bond index, the blue line is the earnings yield of world equities. And that's dominated returns for much of the decade, the so-called TINA, there is no alternative to equities. Suddenly those lines have come very close together and you can see the value there in corporate bond debt. Second, the underlying earnings pictures argues for some opportunities, particularly in dividend and income funds over the year ahead. Why? Because first of all, underlying earnings are quite robust. We're expecting somewhere between 10, 12, 13% for global earnings 1 year forward. What's particularly attractive though on that top right-hand panel is dividends, which we think will grow at around about 7.5%. Now again, that's a very compelling number against that underlying UK inflation rate of 2.5%. In addition, share buybacks are still robust, so the total return to investors is attractive. Now, how do you balance this between growth and value? In the left-hand panel on the next slide, you can see the red line, the S&P 500 growth index dominated by technology, leading very heavily over 10 years. But interesting, over the last 3 years, that number has begun to narrow, and you've been seeing better numbers out of value stocks. Now, we're not ready to make a big pivot yet because on the right-hand panel you can see for the first 2 or 3 quarters of this year, still those supercharged technology earnings, particularly from the so-called Magnificent Seven, will dominate returns. By the end of the year, though, the earnings projections for value and growth become more aligned. So we make a steady transition and a steady but slow move to take some of our high-value growth stocks and put them into income and dividend strategies. Opportunity 3, climate change. Of course, we know the capital expenditures number here are extraordinary, but we also must be aware that China tends to come into many of these opportunities very heavily, boost hugely output and destroy margins and pricing power. They've done this in solar panels, they've done this in the infrastructure behind offshore wind, and they're now doing it in electric vehicles. But we're heavily attracted to many of the other areas where US and Europe have particular niches. Infrastructure and smart buildings, low carbon power, resource efficiency, and particularly high carbon emitting industries like transport and airlines that change their overall operations. And they can take advantage of extraordinary price advantages. You can see in that right-hand panel from the IMF, the falling costs of energy pushing particularly offshore wind and solar voltaic almost below any other source of underlying energy. On the left-hand panel, the IEA also made the very good point that electrification raises demand for key critical minerals by 2 to 7 times by 2030. So copper, rare earth elements, lithium, perhaps uranium, and even at the right price, carbon credits are all part of a modern climate change orientated portfolio across multi-assets. Fourth and finally the UK, where the numbers just appear to be a little bit better than expected, despite the obvious political risk of the election sometimes toward the end of the year. Where are things changing? Well, first of all, on that left-hand panel, I plotted the red line, which is expected inflation for underlying consumers fear for the economy in the year ahead. That's come down from over 6% to 4% and falling. And as those inflation expectations fall away, consumer confidence tends to rocket. And that's certainly what we're now beginning to see in the UK. In addition, other indicators are positive. The so-called PMIs, the Purchasing Manager Indicators, industrial surveys, remember over 50 is expansion, under 50 is contraction, place the UK extraordinarily on the composite index at number 4 in the global economy, well ahead of its other European peers, which lag somewhere around the bottom. Yes, of course, there's political risk, as I indicated, but I don't think it's very material because the policies, at least economically, are so similar between Rishi Sunak and Keir Starmer. I've taken extracts from both of their manifestos on this page, and issues like putting economic stability first, backing entrepreneurs, backing British business, supporting working families are universal to both manifestos, as I indicated. Yes, there's one big difference. Rachel Reeves is promising for Labour a 28 billion climate fund, but when pushed on this, she said only if economic stability allows it. So ironically, I think, compared to some of the more high-risk electoral outcomes, particularly in the US and parts of Europe, the UK is something of a safe haven. What do you do to reflect that in portfolios? Well, allow the sterling content to creep up. We've also already seen the pound in a sort of stealth rally coming out of obviously the horror of the Truss Kwarteng budget. But I think it could go higher. And we've got targets internally to get near to purchasing power parity of somewhere around 135 to the dollar. So I hope those 4 strategies are useful. I hope they show you where you can go for positive returns in 2024 despite the political risks which are so clear to everyone. But I hope that's helpful and see you in a month.